Welcome to the Real Estate Roundtable's first call to talk about our COVID-19 pandemic call to arms for the real estate industry. We welcome all of you and hope that these communications will be very useful and informative for you and your business. Today, we're going to talk about what policymakers have already done. They've introduced some big, bold actions on both the legislative and the administrative side, particularly with the passage of the CARES Act and also numerous actions from the Fed that have worked to stabilize and backstop various of the capital markets. So sit back and enjoy our CEO, Jeff DeBoer, and the talented RER team talk about what we're doing in Washington.
My name is Jeff DeBoer, and I'm President and CEO of the Real Estate Roundtable. Like nearly all Americans, I'm working from home or attempting to work from home, and we all know why. A life-threatening health crisis has swept the globe. The health crisis, in turn, has created great economic dislocation. Millions have lost their jobs, and countless businesses across the country have shuttered. The result, an almost overnight cessation of income, resulting in mass unemployment, the hoarding of cash by individuals and businesses, and tremendous pressure on Washington lawmakers and regulators to find a solution to arrest the deteriorating situation that we're all now well aware of. Since this health crisis began and its impact on economic activity became apparent, our chair, Deb Cafaro, and our board of directors has been actively engaged in reviewing the situation, gaming out potential results, and charting a policy course for us to follow here in Washington. Our perspective has been to actively support legislation and policy action that would provide rescue funds to individuals and businesses to help them meet their obligations. People need and businesses need funds to put food on their tables, to pay utilities, to pay taxes, and yes, to pay their rent and their mortgages on their shelter and their place of business. At the same time, we began outreach to the various regulatory agencies that enforce the rules of the road for the major sources of credit to businesses in general and to our industry in particular. Unfortunately, the result has been 3 major rescue bills from Congress and the authorization of a variety of new liquidity facilities that will function under the direction of the Federal Reserve. Unfortunately, despite this quick and sweeping action by the President, Congress, and federal regulatory agencies, we now fear that the lethal health crisis that created the immediate economic damage now threatens our financial system, thereby potentially creating enormous obstacles to economic recovery once the COVID-19 virus is brought under control. Increasingly, it is clear to our board and to me that the action thus far is not enough to ensure that people and businesses are able to meet their ongoing financial obligations. Specifically, it is clear that the income streams of nearly all types of rental real estate will be severely interrupted. The impact of rent across the nation being interrupted for an undetermined amount of time going forward is now threatening our industry tremendously, and you all know that very well. It is contributing to dysfunction in the credit markets, and it will disturb the affected income of millions of people living on pensions and their other retirement funds that are invested in real estate across America. Troubling provisions regarding eviction moratoriums associated with all tenants in buildings with federally guaranteed loans such as Fannie Mae, Freddie Mac, or HUD are contained in the recent legislation. States and cities are exploring rent holidays, and a grassroots rent holiday advocacy movement is growing. Moreover, if these developments are left unchecked, they will continue to cause great damage to the broader economy, and they will threaten the financial system itself. It is the view of the Real Estate Roundtable that our industry, each one of us, must become much more active, much more aggressive in pointing out the dangers that lurk ahead. We must communicate the connectivity of our industry to jobs, pensions, 401k returns, and so forth. When economic hardships have struck in the past, our industry has historically worked tirelessly to help find a positive path forward. We have done it without seeking self-serving subsidies and with a compassionate eye towards those less fortunate. We must do that again. We must find a balance that recognizes the inability of some to meet their current obligation, yet encourages those who can meet their obligations to continue to do so. The financial system must facilitate positive action to allow issues to be worked out without penalty and without temporarily following strict enforcement guidelines that were written for normal times, which now, if allowed to act, will be pro-cyclical and make credit markets worse and make the economic situation worse. We've had a membership-wide town hall conference call. I hope you all listened in on that. We've had several calls with the CDC to understand the health crisis itself. Our membership policy advisory committees, particularly our tax committee and our credit and capital committee, have been at this 24/7. It's been a nonstop work here, but it isn't enough. So today we begin a new effort to inform and engage Roundtable members in understanding what's at stake, how Washington is responding and has been responding, and how we, working together and side by side with our industry trade association friends, that we can meet the challenge ahead. In the coming weeks, we'll augment our usual weekly e-newsletters and our other forms of communication. And we invite you to look at them all. And we're going to use video blogs like this one to help get the message out and help talk about this. Sometimes, like today, our video blog will be your Roundtable senior staff talking about issues. And sometimes we'll include Roundtable members, and sometimes we'll include members of Congress or policy makers in general in our discussions. Regardless, our goal will be to unroll policy actions that we've identified and ask for your help to advocate them here in Washington. Before I turn the conversation over to our team, I want to remind everybody that on our website, we have a page devoted to all of this information. You can see our document that summarizes the recent bill, all of the various letters that we've written to regulators regarding issues of importance, like the mark-to-market issue, and a variety of other things. So please visit our web page. And now, I guess I would like to ask our Roundtable staff, who really have been at this 24/7 during this crisis, to walk through the key actions of the past 10 days. We're going to focus on the CARES Act, actions by the Federal Reserve, and consequently our actions to date. So we're going to begin with Dwayne Desiderio, and then Chip Rogers is going to give us his views, and we'll conclude with Ryan McCormick. So you're going to see a lot of us, and we wish you health. We wish your families health, and we hope that we can find some policies to go forward for everyone to weather this storm. So let's get started. Dwayne, why don't you talk to us a little bit about the CARES Act and in particular these small business provisions, please.
Thank you, Jeff. Happy to. Good morning, everyone. So as Jeff mentioned, in the bill that Congress passed last Friday, the $2 trillion plus phase 3 bill to respond to the coronavirus emergency, there is a significant section in the bill that would give $349 billion for an emergency small business loan program. The program would be run by the Small Business Administration, and it would supplement and in many ways expand the primary SBA loan program that has been in effect for a number of years. I think there's a couple of really big takeaways to bear in mind in terms of top line points for the SBA's program. Regulations were released last night. We understand that they will take effect immediately today upon their publication in the Federal Register. We've put up on our website what these regulations are, so we know a lot of folks will be looking at them closely. The large point, though, I think to keep in mind, and this is the message that the administration wants to send, is that every small business in the United States should know it can keep its employees. The main goal of this program is to keep people on payroll and keep paying them at least through June 30th. The covered loan period for this program goes from February 15th through June 30th. Small businesses are certainly the goal for them to not lay off their workers. Under this Paycheck Protection Program, banks should also know that it is their opportunity to make loans to small businesses Individual borrower applicants at the small business level do not have to go to the SBA for these loans. They can go to their banks. And there are a vastly expanded universe of banks under the bill that are authorized to originate these loans, not just traditionally SBA approved lenders, and there's a lot of them, but more banks just beyond that. I think there are two really big elements to just hit upon briefly with regard to this Paycheck Protection Program. One is the loan amount and what the loans can be used for, and then also the forgiveness element of the loan. There are a portion of these loans that are basically converted to grants that are 100% backed by the federal government. So let's talk a little bit about the loan amounts and who qualifies for these loans. So the maximum amount that a business can get under these loans is $10 million or 2.5 times payroll, whatever that lesser amount is. $10 million or 2.5 times payroll. A big question that we are confronting, though, is who is eligible to take out that amount. Under the bill, there are new provisions and expanded provisions relative to current law that a business with 500 employees or less are eligible for these loans. So there are three facets here that a business needs to keep in mind. One, if it is a traditional small business, it's eligible for these loans. Two, if the business is franchised and on SBA's franchise directory, it's eligible for these loans. And three, and perhaps more confusing and a bit more controversial, if a business has 500 employees or less, it's eligible for these loans. One of the key questions we have been trying to respond to over the last 2 weeks is, what does a business do if it has multiple affiliates across multiple locations? Does it aggregate and count up all the employees at all of those locations? Or does it just look at the employees at a particular location to see if it fits within the 500 employee count? There's not a simple answer to this question. And in fact, in the regulations that SBA came out with last night, it said that further rules will be forthcoming on this aggregation issue. Suffice it to say, though, as best as we understand at this point, if you are a business in the restaurant or hotel or bar industry, if that is your concern, you do not have to aggregate and add up affiliates across all of your individual locations. If you are a franchise, it would appear, at least based on the very language of the statute, a franchise location is considered its own entity for purposes of the 500 employee count. Only look at the workers at the particular franchise location. However, for other industries, at least at this time, it would appear that affiliation rules that regularly apply under the SBA program continue to apply here. You'd have to aggregate and count up your employees across all of your locations. The Roundtable has advocated and will continue to advocate in letters that we sent to SBA this week that the aggregation rule should not apply if a particular business location is established as its own LLP or LLC under state law. But thus far, we have not gotten that clarity from the SBA to reach that conclusion, but we'll continue to advocate on that front. So that's, I think, point number one in terms of the amount of the loan and who qualifies based on this 500 employee count in particular. Just talking briefly now, again, to the second point that we're getting a lot of questions on, the loan forgiveness components of this bill. So as mentioned at the top, an 8-week portion of the bill can be outright forgiven for certain forgivable costs. In the regulations that came out last night, at least 75% of the loan amounts can be used to cover payroll and worker benefits, and up to but not exceeding 25% can be used for non-payroll purposes. So that would include rent. So again, the prior component of this program is for businesses to keep their employers on payroll. But there is at least an element of this where a portion of these proceeds can be used and would be outright forgiven if the business uses a portion of these for non-payroll amounts such as rent, mortgage interest, and utility bills. One final point, there is certainly concern that we have been hearing from the banking community that there needs to be minimal regulatory friction in this program. The goal is to get the money out the door as soon as possible to these small businesses. the certification that a borrower must make to obtain these loans is rather minimal. There's not a lot of documentation that needs to be provided, but importantly, in the SBA regulations that came out last night, there's not a requirement on lenders to verify what the buyer is putting forth in its certification. It can trust what the certification is. If ultimately the borrower put fraudulent terms in its certifications, there might be ramifications after that against the borrower. But if the lender relies in good faith on a borrower certification that subsequently turns out to be false, the way that we read the regulations that came out last night, there are no negative impacts on the borrower. But I'll stop there. There's certainly a lot more information that we provide on our website on this program. And with that, I'll turn it back to you, Jeff. Thanks.
Thanks, Dwayne. Fantastic work on this. You know, you talk a lot about these small businesses and restaurants and hotels and so forth. And the reason we're very active there is we're trying to get the funds in their hands, again, so that they can meet their obligations, particularly meet their rental obligations, so that it won't cascade throughout the system. We are disappointed that the way this loan forgiveness program works is that rent is not as highly incentivized as other expenses for businesses. And same is true for individuals. And we need to work on that. And I'm not sure if we're going to get into it on this call, but we will at some point. The medium-sized businesses, those with more than 500 employees, and there is no incentive in that program that the money that is borrowed is used for expenses like rent or mortgages, or for that matter, for utilities or taxes. And that is problematic, but we'll talk about that later. Chip, why don't you walk us through some of these Fed lending facilities, and let's talk about that for a minute. Chip.
Thank you, Jeff, and thank you, Dwayne, for that insightful summary on the SBA programs. We've been working on sort of two fronts on credit and capital market issues. One is on the credit facilities, as Jeff alluded to, and also on various aspects of potential regulatory forbearance. Let me start by talking a little bit about that, and then we'll get into the credit facilities. The overall commercial real estate market, roughly $16 trillion, about $4 trillion of debt on that, mostly provided by banks, life companies, and CMBS, commercial mortgage-backed securities. So we've been looking at all aspects of sort of that daisy chain of cash flow that comes from income-producing properties. The industry is now facing one of the worst liquidity challenges since the Great Financial Crisis, certainly maybe since the Great Depression. And so, and commercial real estate is feeling the impact of all that, as Jeff alluded to. Liquidity is largely dried up, and it's cascading through the industry at a lot of levels, particularly on assets that several weeks ago had great values, and now because of a lack of liquidity in the marketplace, the values have frozen or plummeted. So we've been looking at various different potential measures, including potential forbearance in some way on mark-to-market accounting. And we've had some very constructive discussions with the FASB on that. We're continuing to speak to regulators about that, and that ties into the CECL standard, which has to do with expected credit losses that banks are expected to adjust and reserve capital for. So as with no active market in all of these mortgage-backed securities and commercial mortgage debt instruments, the write-downs are causing problems throughout the system. So we've been looking at that. We've been looking at CECL. I will note that the Federal Reserve and the Treasury have done a lot thus far in a short period of time. In a March 20 interagency statement put out by the bank regulators, they suggested basically regulatory forbearance on the treatment of troubled debt restructurings, which is very helpful on the bank front, and that applies to all banks. and credit unions. And then one important provision of the CARES Act actually is some regulatory forbearance on CECL, on the expected credit losses standard that has recently been implemented there. We've requested that be expanded to include life companies and other non-bank financial institutions. That's still in play. We've also been working with the NAIC on that. And so there are a lot of efforts in play there on those measures. So we think that will eventually bear fruit. Concurrently, part of the CARES Act involves a $454 billion basically equity investment to the Federal Reserve that will help them stand up various credit facilities. So far, there's 6 facilities up and running, including a TALF program, reminiscent of the 2008-2009 program, Term Asset-Backed Securities Loan Program, loan facility. That program is now doing business with a number of real estate instruments, including agency commercial mortgage-backed securities. We've requested that it be expanded to include CLOs and non-agency CMBS. So that's very important too. I think that request is in play now with the Federal Reserve Bank of New York, Federal Reserve Board in DC, and also the Treasury Department. So we continue to work there. The program basically, so this $454 billion is essentially equity that can be levered by the Federal Reserve by 10%. So you get a total liquidity package of about $4.5 trillion out there in the marketplace. The Main Street Business Lending Program is the other program established by the CARES Act that is being stood up. The details of that have yet to be released. They'll be released any day now, we think, that will provide, help create a mid-sized lending facility for businesses. And we're hopeful that will provide additional liquidity tools for the market. I think with that, I'll turn it over to Ryan or back to Jeff, and we can and then we can go to questions later.
Great, Chip. Thank you very much. While you're talking, I started thinking about, why are we talking to banks about troubled debt problems? Why are we talking to the SEC about setting aside temporarily full activity of the mark-to-market stuff? Why are we doing all of this? And it's because the basic credits, the real estate asset behind these assets are impaired. They're impaired. The credits are impaired by the lack of rent, and the rental stream has been impacted. So we're over at the banking and the lenders talking to them, but also it has created a lack of confidence within secondary markets, right? And so there hasn't been any CMBS issuance since March 15th. This is causing a freezing up in the marketplace. Without an active, functioning secondary market, new issuance won't go forward. And so all of this hangs together, but all of it goes back to the same source. The income stream on these assets, which were perfectly or largely perfectly healthy a few weeks ago, has been disrupted, and the future income streams is uncertain. We need to reconnect that in order to get the impairment to the credit and the liquidity impairment straightened out so the economy can function. Thank you, Chip. Let's go to Ryan. What about taxes and what's in the bill and what are you working on? I know you're talking to Treasury all the time. Go ahead.
Absolutely. Thanks, Jeff. So yes, I'll take maybe just 3 minutes and talk about some key elements of the phase 3 bill for real estate, maybe 2 or 3 minutes on issues that we think are still large and still out there that we're working on and trying to get some relief from Treasury and from Congress. So within this huge $2+ trillion bill, about $600 billion of it was on the tax side. And all of that is really aimed not at stimulating any kind of investment or activity or spurring development or construction. It's all about cash flow relief. So the aim here is really to see what can be done through the tax code to help boost cash flow during a period of economic inactivity half of that $600 billion is in one provision, which are rebates to individuals and families, checks that are going out over the next few weeks. The other half of it is largely on the business side, and there's a number of pieces there that are going to be important to our industry, to owners and investors. Probably one of the most important ones there is the 5-year carryback of net operating losses. And this is a provision that applies not just for losses in this year, but it's going to be also for losses in 2018, in 2019, and 2020. And so for businesses that are carrying forward losses on their books because they're not able to carry them back anymore under the 2017 tax reform, this will permit them to go back 5 years in time, amend prior tax returns, and get a immediate cash infusion. So hopefully those will be able to be processed quickly by the IRS and help generate some significant cash flow for businesses. Another big provision is a employee retention tax credit. So here it's a credit of up to $5,000, fully refundable for wages paid if the business is subject to a government order that's either fully or partially suspending the business, or if the gross receipts of the business go down by 50%. So there's a lot of details that are still being worked out on that, but that's a significant additional measure that's kind of designed to encourage employers to continue keeping people on payroll. Importantly, this is a provision that kicks in if you're not in this SBA loan program that Dwayne talked about, of which we think there are a lot of mid-sized businesses and others that are going to exceed the size limitations for the small business loan program. This employee retention credit is going to be an important part of the government relief. Another one is qualified improvement property. Essentially, this is immediate expensing or accelerated depreciation of all kinds of improvements to non-residential property, leasehold improvements, common areas, basically anything other than an enlargement of the building. There was a problem in the 2017 bill that extended the life of those improvements cost recovery wise to 39 or 40 years. This brings it back down to, depending on the taxpayer situation, 20 or 10 or 20 or 0. But what's really important here is not this provision. No one's, I think, thinking about depreciation right now going forward. It's going to also allow people to amend past tax returns and get a refund on their 2018, 2019 tax returns by getting this qualified improvement benefit. I'd say those are probably the most important provisions in the CARES Act for real estate businesses. And another one that could be of interest, which is the ability to defer payroll taxes for a couple of years. So in effect, it's basically like an interest-free loan to the extent of payroll tax liability for the employer through 2022. So, that's kind of some of the big pieces that are in the bill. What we're currently, in addition to those elements, what we're working on are a number of issues. One would be like-kind exchanges. So a lot of concern about how the cessation of activities affecting transactions that have been contemplated kind of before all this started. If it's initiated a like-kind exchange, you have to identify your replacement property, and then you have to relink and then close on that transaction. There's strict deadlines. Treasury has the authority to extend those under its disaster tax relief authority. We're working with Treasury and our other real estate partners to get that done. That needs to be done soon. People are waiting on that type of relief so they know what's going to happen with like-kind exchange transactions. Similarly, with opportunity zones, there are a number of strict deadlines associated with rolling money into an opportunity zone, investing in a fund, substantially improving the property once the fund makes an investment, and when the compliance with the opportunity zone requirements are tested. All of those things have strict dates and deadlines, which can be extended and through disaster tax relief authority that Treasury has. So we're working on that. Probably a bigger issue though overall over the next several months is going to be what happens when we have a lot of debt restructurings, debt cancellation, debt forgiveness as a result of what's going to need to be some realignment of financial obligations coming out of this severe economic recession crisis. And that has there's a big tax issue associated with that, which is when you do have a debt restructuring or you do have debt forgiveness, under current law, that generates the party getting the benefit of the forgiveness has taxable income that they have to recognize at the end of the year. Cancellation of indebtedness income. That can be, we believe Treasury's got the authority to waive that at least for a year. And then we want to also go to Congress and in the next legislation, try to get a full exemption of any kind of cancellation of debt income over the next 90 days or so, or over the period in which this national emergency is in effect, so that parties can come together, realign their obligations, and not have a taxable event associated with that. And we think that will help facilitate some of the kind of private party realignment and negotiations that really need to occur here. So those are just a few of the highlights or other areas where the Real Estate Roundtable's Tax Policy Advisory Committee is kind of actively engaged with Treasury, with the Hill and the tax writing committees on implementation of some of the stuff from the CARES Act and elsewhere. But it kind of gives you a sense of the big items, Jeff.
Jeff?
Yes.
I just add one quick point to what Ryan said, to the SBA issues that we talked about at the top. We mentioned that a portion of those SBA loans are forgiven, and dovetails great with what Ryan just mentioned. The forgiven portion of an SBA loan, that 8-week period, which is essentially a grant, does not trigger tax consequences. It's not treated as income. So there is at least some precedent in the legislation that Congress passed last week that would acknowledge, at least for the SBA side of the equation, debt forgiveness does not generate taxable income.
Great. Thank you. Well, just listening to you gives me great confidence that we're on the job. We're doing what we can do. We're looking at all the important issues. I think every roundtable member should feel very good about what they just heard and the work that's being done. But I don't want to pretend we're doing it alone. We're doing it with all of our partners at the other trade associations. NAREIT, for example, on tax things that Ryan just talked about. We're exploring items there where some of the related party rules might inhibit a REIT from helping out a tenant in terms of equity contributions and other issues. We're working with the mortgage bankers, the multi-housing council, the apartment association regarding this whole rent moratoriums, eviction moratoriums, and so forth to try and find solutions there. And on it goes, and to get with other organizations to work on the TALF and so forth. So we're all working together. We need your help. I'm wearing a glove because we have to go about this with compassion and understand that there are a lot of people and a lot of businesses that need help, and they need help more than we need help right now. So we need to make sure that we can help them do that. But I also have a hammer, and we need to use the hammer to make sure that policymakers understand the situation that we're in, and the action must be done without the partisan politics that's been going on, and without the winners and losers and picking and putting in bills pet projects that have languished on the shelves for years. And we need to talk to all of them in straight, direct language. We're looking forward to working with our members, with the other trade associations, and with everyone to get the message across. And I want to end, as I began, I think, with wishing you good health, your family's good health, and we'll be back in touch. Thank you very much. Have a good day.